Let's talk about the housing affordability crisis. But, instead of just staring at the problem, we're going to dive into some really fascinating new blueprints. These are innovative financial and construction models that are designed to finally unlock the door to homeownership for more people. So let's just start with a question that I'm pretty sure is on a lot of our minds. It just feels like buying a home is way harder than it ever was for our parents or grandparents. But is that just in our heads, or is it the reality of the situation? Let's take a look at the actual numbers. And yeah, the numbers are, well, they're pretty staggering. If you go back to the year 2000, it took the average Canadian first-time buyer about 5 years to save up for a down payment. Okay, 5 years of really focused saving. Today, that number has shot up to over 16 years. That isn't just a small hurdle. For a lot of people, that's a complete wall. It's blocking them from ever even thinking about owning a home. So what this creates is a situation that experts are now calling the home ownership lockout. But who exactly is getting locked out? It might not be who you think. We're talking about a group that economists have dubbed the missing middle. And as you can see here, these are folks who are pretty much the backbone of our cities. We're talking nurses, teachers, skilled technicians, young families starting out. They have steady jobs, they have good incomes. They're the exact people you would think should be able to buy a home. So why are they the ones being locked out? Well, this slide really lays out the paradox that they're trapped in. It's a real catch-22. On one hand, their income is too high, so they don't qualify for any kind of subsidized housing or government help. But on the other hand, in today's wild market, their income isn't nearly high enough to actually afford a home, especially when you're looking at a 16-year saving plan. They are, quite literally, stuck in a financial no man's land. Now, right about now, you're probably thinking, hold on a second, aren't governments spending an absolute fortune trying to fix this exact problem? And you'd be totally right, they are. But this is where the story gets a little more complicated. So, since 2017, Canada's national housing strategy has ballooned into a plan that's worth more than $115 billion. I mean, that is just an astronomical amount of money. So you'd think with all that cash flowing, the problem of the missing middle must be on its way to being solved, right? Well, not quite. When you actually analyze where that money is going, you see this really critical pivot. The strategy has shifted away from giving direct subsidies to people to make housing cheaper for them. Instead, the focus is now on giving low-interest loans to developers to build more rental apartments. So the whole strategy basically moved from helping buyers to incentivizing builders. And this chart shows you the direct result of that shift. Look at the left, those are the older grant-based programs. They created truly affordable units with rents down around $716 a month. Now look at the right, that's the new loan program, the one that gets the most funding. The units it creates have an affordable rent of over $1,500. For a huge part of that missing middle, that's just not affordable, plain and simple. The spending isn't matching the need. Okay, so if the massive government strategy isn't the whole solution, what is? Let's pivot to our first big idea, a really innovative model that's all about hacking the single biggest barrier for most people, that giant down payment. This is a shared equity model called CAHOME, and how it works is, honestly, it's brilliant. As you see here, the buyer only needs to come up with a 5% down payment, okay? Then they get a normal, conventional mortgage for 75% of the home's value. But here's the part that unlocks the whole thing. An investment fund comes in and provides the last 20% as a second mortgage. And here's the magic part. It's completely payment-free. You don't pay 1 cent on that 20% loan until you decide to sell the house someday. The core idea here is incredibly simple but so powerful. By getting rid of the payments on that big 20% chunk, your total monthly housing cost is designed to be about the same as what you would be paying in rent anyway. The massive difference, of course, is that now, instead of that rent money just disappearing every month, you're actually building equity. You're owning a real asset. Now, what I think is just fascinating about this model is how it gets everyone on the same page. That's so rare. Let's just walk through this. The home buyer obviously wins. They get a home with payments they can actually handle. But look at the developer. They get to sell their units faster and at full price, which can actually boost their profit margins. And the government? They get to meet their housing goals with a fund that recycles money instead of just giving out grants that vanish. And finally, the investors who put money into that fund, they get a stable, low-risk return that also happens to be socially responsible. It's this incredible framework where everyone has a real reason to get on board and nobody loses. So, hacking the financing is one piece of the puzzle. But what about the physical house itself? Our second model, BHOME, tackles the rising costs and, just as important, the risks of construction, especially as our climate keeps changing. All right, so that's the money side. But what about the actual bricks and mortar, or in this case, steel? This next model changes how the home is physically built. Instead of doing everything on site, it uses what's called modular building. So big sections of the house are built inside a factory. And this one change has massive benefits. You don't have weather delays, the price is guaranteed from the start, and the homes themselves are incredibly strong. We're talking a steel frame that can handle hurricane-force winds. But, building a tougher house is only half the battle. You still need a bank to agree to finance it. And this is where this model gets really clever. It wraps the entire project in what they call a multi-layer insurance shield. You can think of it like financial armor. It includes special policies that lower insurance costs, guarantee a fast cash payout after a big storm, and even protect the bank if the factory building the house runs into trouble. What it all adds up to is this. It takes away the big scary risks, which gives banks the confidence they need to say yes and lend the money. And because the project is so much safer from a financial standpoint, it attracts a whole new mix of funders. Take a look at this capital stack chart. The biggest slice, that 60%, that's still your traditional bank mortgage. But what's new is how it's blended with government loans, money from nonprofits, and, this part is really interesting, even contributions from local employers who want to help their own workers find stable housing. It's just a powerful example of how you can bring all these different types of money together to tackle a big, complex problem. So we've looked at hacking the down payment on one side and completely re-engineering the physical construction on the other. What does this all mean when you put it together? Well, it signals a really fundamental shift in how we think about this problem, and this quote just captures it perfectly. The old way was all about one-time subsidies, money that gets spent and then it's gone. These new models are designed to be perpetual affordability mechanisms. The capital gets invested, it gets paid back, and then it gets recycled to help the next family and the family after that. They are built to last. And that really leaves us with one final, and I think, really important question. For decades, it feels like we've been searching for a single master key that's somehow going to solve the entire housing crisis. But what if that was the wrong approach the whole time? What if the real solution isn't one key, but a whole new toolbox filled with creative, adaptable, and sustainable tools just like the ones we've explored today?